People keep acting like this all exploded overnight, like someone flipped a switch and silver suddenly lost its mind. But that's not how systems like this break. They don't snap. They stretch, they strain, and they whisper warnings for years before anything visible happens. What changed this week wasn't the underlying pressure. What changed is that the usual gatekeepers finally lost their grip on the price, even if only for a moment. And when that happens, history is pretty clear about what comes next. Institutions don't shrug and accept it. They don't allow clean, honest price discovery. They reach for the levers, they rewrite rules, they intervene. And that's exactly what we watched unfold. While most traders were glued to charts, watching silver sprint toward the mid-80s and refreshing their screens like it was a sporting event, the real action was happening somewhere far less exciting and far more important. Not on social media, not on a candlestick chart, inside the plumbing of the financial system itself. Early in the morning, almost quietly, the CME group released what looked like a routine emergency advisory. Notice 2609. To most people, it read like dry administrative housekeeping. To anyone who understands how markets are actually controlled, it was a flare shot straight into the sky. Effective immediately, the CME changed how margin requirements for precious metals are calculated. Out went fixed dollar margins. In came a percentage of notional value. For silver, that percentage was set at 9%. On the surface, that sounds boring, even reasonable, but math has a way of stripping away comfort. With silver trading around $85 an ounce, the cost to hold a single futures contract jumped roughly 15% overnight. Margin went from about $32,500 to more than $38,000 per contract. Nearly $6,000 due immediately. No grace period, no slow adjustment. That's not a tweak, that's a command. So why now? Because the move the day before wasn't a gentle climb. Silver didn't stroll higher, it went vertical. It gapped from $82 straight through $85 and briefly tagged $86 in the electronic session. For commercial banks and large players sitting on massive paper short positions, that kind of move isn't uncomfortable. It's existential. Another few dollars in margin calls don't just hurt, they cascade. Risk departments panic. Liquidity drains fast. The system needed buying pressure to stop immediately. And when you can't stop demand, you attack leverage. This is how exchanges force the issue. Every leverage trader gets handed a very simple choice. Wire in a pile of fresh cash right now, or we liquidate you for your own good. It's not subtle, it's not organic. It's a liquidity drain by design. And it's not new. We saw the same playbook in 2011. We saw it again in 2020. Different year, same reflex. For a moment, it looked like the tactic worked. If you were watching short-term charts, you saw it happen in real time. As soon as the margin news hit terminals, silver dropped hard from around $86 down toward the low 83s. Those red candles weren't fear. They weren't fundamentals. They were algorithms and forced liquidations reacting to a rule change. That was leverage being flushed out of the system, plain and simple. By tonight, the headlines will tell a neat little story. They'll say the rally is over. They'll point to that candle and declare the bubble popped. They'll want you just scared enough to doubt yourself, maybe even dump physical metal because a screen flashed red for a few minutes. That narrative has worked before. But here's the part they really don't want you staring at too long. In 2011, margin hikes crushed silver. 5 increases in a single week drove the price down nearly 30%. $50 collapsed to the mid-30s in days. It was brutal. This time, we got one margin hike, about 15%, punitive by any reasonable standard. And the price fell roughly $2.50. That's it. And even that drop didn't stick. Look at the structure. Look at the wick. Price dipped into the low 83s and was immediately bought. As of this recording, silver is still holding around $83. It refused to roll over. That matters more than any headline ever will. The system fired one of its most powerful weapons directly at the market, and the market barely flinched. That's not weakness, that's resilience. The reason this time is different has nothing to do with chart patterns or moving averages. It's about who is buying. The bids sitting at $83 are not momentum traders chasing a squeeze with borrowed money. They're not speculators hoping for a quick flip. They are industrial consumers, sovereign buyers, entities paying cash. You can't margin call someone who wires the full amount. If a manufacturer needs silver for electronics, batteries, medical equipment, or solar components, CME margin rules are irrelevant. They're not gambling on futures. They're securing supply. When price dips, they don't panic. They get efficient. This is why margin hikes don't stop physical demand. In fact, they often reinforce it. Weak hands get shaken out. Paper longs get punished. And cheaper metal is delivered straight into the hands of the strongest buyers on the planet. Same ticker symbol. Two completely different markets. That split is now impossible to ignore. On one side, you have the paper market, leveraged, rule-driven, constantly adjusted to protect insiders. On the other, the physical market, governed by scarcity, logistics, and real-world necessity. You can manipulate one for a while. You cannot manipulate both forever, and if the margin hike was the financial system's panic response, what happened out of Washington was the political one. While the CME was rewriting the rules of its casino, the U.S. Treasury was doing something far more revealing, asking for help. Multiple reports indicate that Treasury Secretary Scott Bessent convened an urgent, unscheduled meeting with G7 finance ministers. Officially, the topic was securing and diversifying supply chains. That phrase should immediately get your attention. Governments don't call emergency meetings in the middle of a price spike, unless something's already broken. This wasn't about abstract policy goals or long-term planning. It wasn't on anyone's calendar weeks in advance. The timing tells the story. Silver spikes, Asian premiums explode, inventories vanish, and suddenly the world's most powerful financial bloc needs an urgent conversation about supply. When officials talk about securing supply, it means flow is already disrupted. When they say diversify, it means they're dangerously dependent on sources they don't control. Diplomatic language is polite by design, but once you learn to read it, it becomes brutally honest. Silver production and refining are not evenly distributed. China is a top producer and the dominant refiner. Russia is a major supplier. Mexico and Peru are critical sources. These are not jurisdictions the G7 can simply command. And when physical silver disappears, no amount of financial engineering can summon it back into existence. The margin hike was meant to buy time. The G7 meeting tells you they know time is running out. This is what systemic stress actually looks like. Not a dramatic crash, not screaming headlines, but emergency meetings, rule changes, and quiet admissions hidden behind bureaucratic language. The system is straining under a problem it can't solve with leverage or spreadsheets. They can change the rules of the paper game. They can force liquidations. They can lean on price for a day or two. What they cannot do is print silver, and they cannot force cash buyers to stop buying something they genuinely need. So if today felt chaotic, that's not a bad thing. Chaos is honest. It's what happens when a tightly controlled system starts losing its grip. The most important takeaway isn't that silver dipped, it's that the strongest weapons they have don't work the way they used to. And once that realization spreads, the next phase doesn't require leverage at all. Step back from the noise for a moment and look at the board the way policymakers do. The balance of power in silver is no longer theoretical, it's geographical. A massive share of global supply, refining capacity, and downstream control now sits outside the Western financial system. And today, quietly and diplomatically, the G7 had to admit they are no longer fully in charge of the flow. This morning, Western finance ministers weren't staring at charts for entertainment. They were watching metal physically disappear. They saw Shanghai pulling silver out of London and New York at a pace that doesn't show up neatly on a futures screen. They saw retail demand emptying U.S. mints faster than they could restock. And somewhere in that meeting, an uncomfortable realization landed. There is no buffer left. The United States sold its strategic silver stockpile decades ago. Not trimmed it, sold it. There is no emergency vault to open in a crisis. The entire system runs on just-in-time delivery, a philosophy that works beautifully right up until the moment it doesn't. And as we've been warning, just-in-time is over. The world has shifted to just-in-case. The problem is, the U.S. suddenly realized it has no case at all. None of this came out of nowhere. It connects directly to events earlier this month that many people misunderstood at the time. Think back to January 3rd and what was branded as Operation Absolute Resolve in Venezuela. You were told it was about democracy and stability. Others told you it was about resources. Oil then, metals now. Same behavior, different input. When an empire starts moving aggressively to secure raw materials, it's not because things are comfortable. It's because the cupboard is getting uncomfortably bare. What you're watching right now isn't confidence breaking. It's scarcity anxiety finally surfacing. And like most real problems, it didn't start where everyone is staring. 10 days ago, that anxiety was still contained in currencies and bonds. Today, it has fully migrated into metals. Silver is no longer just an investment story or a speculative trade gone wild. It has crossed into something far more serious. It's become an operational constraint. You can't run a modern military, build a green energy grid, and maintain a digital economy without enormous quantities of silver. That's not ideology, it's physics. Modern warfare is electronic. Every missile guidance system, every advanced fighter jet, every radar array, every drone swarm, every satellite constellation relies on silver's unmatched conductivity. There's no alternative that does the same job, at the same scale, with the same reliability. Engineers don't debate this, they design around it. So when supply chains start snapping, and dealer delays suggest they already have, the military-industrial complex doesn't politely slow down. It stops. And stopping is not an acceptable option. That was why the Treasury Secretary isn't delegating this to a junior committee or issuing vague reassurances from behind a podium. This is personal involvement because this isn't about coins, bars, or collectibles. This is about national security. Once you look at today's events through that lens, the coordinated response suddenly makes a lot more sense. First comes the financial response, the blunt instrument. The CME raises margins aggressively to smash the paper price and flush out leveraged participants. That move doesn't create a single new ounce of silver, but it does one important thing. It buys time. It slows the visible price signal that something is wrong. Then comes the political response. The Treasury convenes the G7 to coordinate how to secure physical metal outside the open market. That's the key phrase, outside the open market. At that point, we're no longer talking about free market capitalism. We're talking about cartel behavior. This is about coordinating with allies in Europe, Japan, and Canada to lock down mining output in friendly jurisdictions like Mexico and Peru before China absorbs it all. And the irony here is almost painful. China has been doing exactly this for years. While the West was busy optimizing ESG scores, inventing new derivatives, and congratulating itself on financial innovation, China was signing long-term offtake agreements and investing directly in refining capacity. They weren't speculating on silver, they were securing it. That's why today's G7 meeting isn't a show of strength. It's an admission of weakness. If they already controlled supply, they wouldn't need to meet. If the market were functioning normally, there would be no need for emergency coordination. The timing alone tells you everything you need to know. Silver spikes, and suddenly the highest levels of government are scrambling to secure it. That $86 price wasn't a bubble, it was a flare. Now pay attention to the language shift, because it matters. For decades, silver was dismissed as a shiny rock, a barbarous relic, something for jewelry and hobbyists. Almost overnight, it has been reclassified as a critical mineral. That doesn't happen by accident. Once something is labeled critical, it becomes eligible for direct government intervention. It opens the door to the Defense Production Act. It allows authorities to prioritize industrial and military allocation over private ownership. And yes, it quietly lays the groundwork for rationing. If a defense contractor needs silver for missile systems, and a tech giant needs it for batteries, and you want it to protect your purchasing power, guess who wins that conversation? Missiles and batteries, every time. That's the uncomfortable direction this is heading. The public doesn't get invited into scarcity management meetings. The public gets managed. You've already seen the early signs. Purchase limits, premium spikes, sudden shortages at major retailers. A growing narrative about hoarders and unproductive ownership. This isn't about fairness, it's about control. They want the metal, and they would strongly prefer you didn't have it. That's why a $2 paper drop caused by a margin hike should not discourage you. It should clarify things. The same institutions leaning on the price are holding emergency meetings to figure out how to obtain the very asset they are trying to make look weak. That contradiction tells you everything you need to know. The margin hike was the distraction. The G7 meeting was the confession. And this isn't happening in isolation. Bond markets are already flashing warning signs, as we saw recently with India's moves. Now commodities are joining the rebellion. Policymakers are fighting a two-front war against economic gravity. And gravity, historically speaking, has a very strong win record. Here's the part that actually matters. None of these tools create supply. Paper tricks don't dig mines. Diplomatic meetings don't refine ore. You cannot legislate a silver deposit into existence. From discovery to production, a new mine takes close to a decade. No communique, no emergency session, no strongly worded statement changes that reality. You can hear the frustration in the system's response. The financial tools are blunt, the political tools are slow, and the market is moving faster than both. Which brings us to the most important question of the day. Why didn't it work? History says margin hikes are supposed to break markets. In 2011, they crushed silver. In 2020, they amplified the pandemic crash and drove prices into the low teens. When the cost of leverage rises, players are supposed to fold. That's the script. That's how the story usually ends. But today, the players didn't fold. They called. Silver dipped into the low 83s and bounced. It absorbed the hit and just stood there, stubborn and uncooperative, like a heavyweight who takes a clean shot and smiles back. That should not have happened unless something fundamental had changed. And it has. The clue is about 7,000 miles away. While New York was busy selling paper, the Shanghai Gold Exchange fixed silver at $9,331. That's nearly a $10 spread between East and West. In previous cycles, that gap simply didn't exist. In 2011, prices across major exchanges moved together. The market was unified. When New York sold, everyone sold. That world is gone. The market is fractured. The West trades promises. The East trades metal. And as long as Shanghai is willing to pay over $93, there is a hard floor under the Western price. Not because of sentiment, because of arbitrage physics. If the CME somehow smashed silver to $70 while Shanghai stayed at $93, that wouldn't end the bull market. It would supercharge it. A $23 arbitrage spread isn't a warning, it's an invitation. Traders wouldn't panic, they'd back up trucks. Metal would flow east at record speed. Comex inventories would be drained in days, not months. That's the Shanghai Shield. It's not a theory, it's a pressure valve that turns Western manipulation into Eastern accumulation. The harder the West pushes the price down, the faster physical supply disappears. This is why today's interventions failed. And it's why the next ones will fail too. The door isn't just closing, it's already off the hinges. The system knows it. The G7 knows it. The CME knows it. At this point, the irony is almost painful to watch. The banks are trapped in a position entirely of their own making, and there is no elegant exit. Every move they consider comes with a cost they can no longer afford. Smash the paper price, and the physical metal vanishes into Asia at a discount. Allow the price to rise, and their short positions bleed into outright insolvency. They're no longer managing a market. They're choosing which limb to sacrifice. And the data released this afternoon quietly confirms exactly which choice is being made. While screens were flashing red and commentators were celebrating a so-called price reset, something very different was happening behind the scenes. The vaults were being emptied. Not figuratively, literally. The depository statistics published today read less like routine reporting and more like an inventory log from a besieged city. Asahi saw over 500,000 ounces leave. Brinks lost more than 600,000 ounces. CNT followed with another large withdrawal. Ounce after ounce, quietly exiting the system while attention was focused elsewhere. That's the real story, not the candle, not the headline. The metal is leaving. And once it's gone, no amount of margin hikes, meetings, or narratives will bring it back. By the time the numbers were tallied, the picture had become impossible to ignore. More than 2.2 million ounces of silver walked out of the COMEX system in a single day. Not drifted, not shuffled, left. StoneX alone saw close to 800,000 ounces removed, another 350,000 vanished elsewhere. And when you added up the rest, the total told a story that price charts conveniently avoid. Any one of those figures would have raised eyebrows. Together, they form a signal flare. But the real damage wasn't in the headline number, it was where the withdrawals hit. The registered category, the silver actually available for immediate delivery, dropped by nearly 400,000 ounces, landing around 123 million. That's the bloodstream of the system. That's the metal that keeps the promises alive. And it's leaking. Here's the part that should make you pause. The margin hike didn't slow that outflow, it accelerated it. By forcing the paper price down into the low 83s, the exchange effectively put silver on sale for the very entities emptying the vaults. The CME tried to starve demand and ended up feeding it. That's not clever strategy, that's self-inflicted damage. This connects directly to the emergency conversations happening at the G7 level. Treasury Secretary Besant doesn't need a chart or a talking head to explain what S happening. He's reading the same inventory reports. He knows metal is moving west to east at an increasing pace. That is why the language coming out of those meetings keeps circling around securing supply chains. They were trying to build a fence around a market that already has a $10 price gap baked into it. And here's the problem with fences. Capital doesn't respect them. Metal doesn't either. It flows to where it's valued most. Right now, that place is Shanghai. This is why volatility shouldn't scare you. When you see a sharp red candle, understand what it's actually testing. There is a floor under this market. And it's not made of sentiment or trend lines. It's made of a standing bid from the largest industrial economy on Earth. Unless the price in China collapses, and there's no evidence of that given domestic demand, the price in New York cannot fall meaningfully without triggering massive arbitrage flows. In practical terms, arbitrage has become a built-in put option. Downside is capped by physics. Upside is open-ended because the short positions are structurally broken. That asymmetry is powerful, and it simply did not exist in previous cycles. What we're witnessing now is the fragmentation of global price discovery. For over a century, New York dictated the price of silver, and the rest of the world followed along. That era is ending in real time. Today, Shanghai sets the floor and New York scrambles to defend its relevance. The margin hike was an attempt to remind the market who was in charge. The market checked the Shanghai fix north of $93 and collectively realized the emperor was not fully dressed. Paper tools only work when physical demand is asleep. Spoofing, wash trades, margin games, all of it depends on a compliant physical market. That condition no longer exists. The physical market is awake, aggressive, and consuming inventory at a pace the paper system cannot replace. Those 2.2 million ounces that left the vaults today are not coming back. They won't be rehypothecated. They won't reappear as eligible inventory. They're being melted, fabricated, installed, and deployed. Solar panels, electronics, defense systems, finished goods. End of story. So now we arrive at the uncomfortable question for the establishment. What's left? Margins didn't crash the price. Policy meetings didn't stop the outflow. Supply can't be conjured out of thin air. Mines take years to develop. When you can't control price and you can't increase supply, the only lever remaining is access. You restrict participation. You quietly close the exits. You make it harder for the public to get involved. And we are now watching that phase begin. Look at the retail side. For the past 2 years, Costco quietly became one of the most important silver distributors in the United States. Tubes of eagles, bars, easy access, high trust. It wasn't flashy, but it worked. That model changed this week. Verified reports confirm that Costco has imposed strict limits on silver purchases. 1 transaction per membership, hard caps on quantity. Think about how unnatural that is in a free market. When demand surges, businesses usually celebrate. They raise prices and sell more. You only limit sales when you are afraid to replace what you are reselling. Costco understands that if they allowed unlimited purchases at current prices, their entire national inventory would vanish in hours. This is rationing. It's polite, it's quiet, but it's rationing. Now look at the U.S. Mint. The institution tasked with supplying the public with official silver coinage released the 2026 Silver Eagles, and they were immediately back-ordered. A full month delay announced. Let that sink in. The United States government cannot stamp 1-ounce coins fast enough to meet demand. That's not a marketing issue. That's a supply chain failure at the sovereign level. This is what happens when, just in case, panic collides with a system built for just in time. And the most technical, most revealing signal of all is unfolding inside the futures market itself. We're seeing backwardation, and more importantly, backward rolling. Normally, as contracts near expiration, traders roll out of the delivery month and into the next one. Routine, boring. Nobody talks about it. But that's not what's happening now. The CME's own open interest data shows something deeply abnormal. We saw 369 delivery notices issued for January, yet open interest only declined by 233 contracts. Translated into plain language, traders are fighting to stay in the delivery month. For every participant trying to exit, someone else is forcing their way in. They want January metal, not March promises. And the reason is simple. They don't trust that the metal will still be there later. This is the textbook definition of a squeeze. Shorts are trapped. Longs are demanding delivery. The exchange is hiking margins to pry them apart. And it isn't working. So what's the verdict on this day? The system fired its biggest financial weapon, a roughly 15% margin hike, and silver is still trading near $84. The Treasury convened the G7, implicitly admitting vulnerability. Retailers have begun rationing, inventories are draining, warning lights are flashing across the board. Today was not about price suppression, it was about psychology. They wanted fear, they wanted capitulation, they wanted that red candle to break momentum and confidence. Instead, the market absorbed the blow and stood its ground. The $80.90 price isn't arbitrary, it's symbolic. It marks the moment the market collectively understood that paper control no longer overrides physical scarcity. If you already hold physical silver, the message is straightforward. Donna T. let rule changes scare you out of the very asset the system itself is scrambling to secure. That metal isn't a trade, it's insurance against the exact crisis policymakers are now openly trying to manage. If you're still looking to buy, understand that the environment has changed. The easy access phase is over. Costco is limiting. The mint is delayed, premiums are climbing, availability is tightening. What remains will not be evenly distributed. From a technical standpoint, the path forward is clear. Resistance around $80 is gone. The test of $85 didn't break the market. The next gravitational point is the Shanghai price in the low 90s. That gap will close, not because of hype or headlines, but because of arbitrage math. The empire tried to strike back today. It used margins, meetings, and messaging, and it